Gary Houston, press to ATO.
Okay, now I got sound. Very helpful. Good morning, how are you? Welcome to FX Street. Trade Non-Farm Payrolls live, baby. So with the rocket music in the background, just so you know, in approximately 3 hours, no, a little more than that, 4 hours, a piece of rocket ship about the size of a small business jet is going to be crashing into the moon at 6,000 miles per hour. So get out your telescopes. Actually, it's going to be on the wrong side of the moon, but anyways, too bad. Good morning. Statistically, 573 hours of non-farm payrolls. Is that right? But I don't understand the 47.75 months in a row. Oh, so wait, outstanding. Oh, so that's for you. You've been coming here almost 4 years or something? Anyways, yeah, very cool. All right, welcome everybody to Trade Non-Farm Payrolls Live number 191. Hey, that's pretty cool, right? Thank you to FX Street for being wonderful hosts and collaborators. We are all here to serve you. I am a humble currency analyst and trader, entering pretty close to 20 years, certainly 20 years of following the market very closely, and close to 20 years of making this my career. I gave up a job as a venture capitalist, grew that firm from, 30 or 40 people to about 300 people. The company before that, I grew it from 5 or 6 people to 300 or 400 people. Interesting, right? Cool. Well, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Now, let's talk about non-farm payrolls generally right now. What is fundamental analysis? I want to start there first. Because we're here for a news event, so let's talk about the role of this news event in our market, so at least we can set the stage properly. John wants to know the whisper number. That's what I'm getting to. Let's talk about that. What is fundamental analysis? News? Nope. News is definitely not fundamentals. News is news. News is an event. Non-farm payrolls is released. It's an event. You find out that the Russians have hit a nuclear power plant. That's a news event. Okay, Trump sends a tweet. That's a news event. Trump not allowed to send tweets anymore. That's a news event. Okay, no. So what is fundamental analysis? Okay, there's a great answer. Macroeconomic forces behind the economy in theory. Okay, good. Let me go with that. That was so beautifully written. Okay. We'll go with that. Not the ability to adapt. No. It's a good answer, Raymond, but that's not correct. It's the trend in economic data. What is the trend in non-farm payrolls? What is the trend in inflation? What is the trend in economic growth? That's all it is. We're studying the fundamental forces to understand the health of the economy. Fundamental analysis of economic conditions. So what is the point then? Why would we do that? Why? What is the raison d'être? If you don't know, type in a question mark. Why do we care? Why should we care? If you don't care, you're like, I don't care. Well, why should you care? To establish sentiment? No. There's more of like a real reason. I don't think sentiment's real. I think it's emotional. Who cares? Determine the health of the economy. Yeah, but why would you care about that? Bias. Yeah, but once again, what bias would you have? Like, yeah, to set your bias, but what sets your bias? To flow, they understand the flow of money, getting there for sure. So a healthy economy might be in an exporting economy. A healthy economy would be exporting a lot. Sure. There you go. Master trader got it. Because of the change or potential change in the near future of the monetary policy of the central bank. And then you can say, okay, based on the trends in this economy, whatever we're studying, you're going to say the central bank should step in and stimulate the economy through, let's say, increasing the money supply. And how do you do that? Maybe lower interest rates, quantitative easing. Or like in the United States and most other countries around the world, they say there's too much inflation. Employment is high, unemployment is low, wages are going up. Okay, so to deal with that, because now we're looking at the trend. Again, the trend in employment, the trend in wages, the trend in prices, okay, the trend in productivity. Is GDP above or below potential GDP? Well, in this case, it would be above potential GDP. So the central bank would look at all these trends, just like you and I. They look at the same data, and they say, we have emergency stimulus policy in our economy right now. Do we need it? And we're like, oh my God, we're almost at full employment. Wages are up. Prices are up. GDP is above potential GDP. Oh my God, we should at least be neutral right now, not stimulative. So looking at the Fed now, they're like, we got to get totally out of quantitative easing. Okay. And we need to start raising interest rates at least to neutral. Okay. And that's why we look at the fundamentals, because we know the Fed's looking at the fundamentals. And then when we can anticipate what the Fed is likely to do next, we can start pricing in those changes. Okay. How many people here knew in October, November, and December that I said the stock market was going to drop 10 to 20% in January? How many people knew that? Like, you knew it so much. We talk about it so much. We do it every year, all that kind of stuff. How many people knew 1,000% that I thought the stock market was coming down 10 to 20% in specific January, in specific, like the first week? Okay. Okay, good. Yeah. Cool. Well, that's nice. But then the question, right, it begs the question, why? And you have to go all the way back and you have to say fundamental analysis. Now, you might say, well, fundamental analysis said everything was good, Wayne. You're not looking forward. You're just measuring the trend. Okay? So instead, you have to say, well, what's the next step? And that is to raise interest rates. Okay? But the thing is, it's not, let's just do Aussie yen, I guess. I just want to go blank. It's not when they raise interest rates. It's when you believe people believe. So maybe that goes to selfishness, strategic traders' idea that, well, that changes the sentiment because they're looking for forward guidance and they're putting together forward guidance. And what happens is interest rates in the future start getting priced into today. Okay, the future value, okay, is equal to the present value over 1, okay, 1 plus I to the n. So let's say in 5 years, what's a stock going to be worth? So then you'd have to say the future value is equal to the present value. So how much money did that company make that in year 1? Okay. And what's the inflation rate going to be? Or what's the interest rate going to be? So like we could do something like this. In the beginning, the business models look like that. Actually, sorry, that's a 1. In year 1, okay? Last year, the stock market was priced as if interest rates are going to be at 0 forever. Remember Facebook before it dropped 50%? Well, why was it worth so much? Because people were pricing in the model of the value of Facebook, looking at how much money they make over a long period of time. So we call that multiples. How many years out are you looking? How many times earnings? But you could also say like, it's almost like how many years of earnings, depending on how you approach it. But as if the interest rate was going to be 0 forever. Free money forever. Well, shoot, if money was free, everyone would be borrowing money and investing it in places like the stock market. So obviously, if everyone's a buyer because money is free, the price is going to be high. So the present value of year 1, okay, but then you have to do this for 5 years. Say how much money did they make in year 2? So you could say revenue in year 2 over 1 plus what's the interest rate now? Let's say 1% over 2 plus, okay, again, that year's revenue or profit, if you will, whatever your model is measuring, plus now what's the interest rate? Let's say 2% to the third, okay? And you do this out, and it ends present value equal 1 plus, okay? Now what's the inflation? What's the interest rate, let's say, going to be in 5 years? Let's say it's 3%. Okay, it slows down. We don't need to jack it up, right? So anyway, so you go through this model and you come out with the price. The thing is, as this goes up, this is worth less and less and less and less and less and less today. What does all of this mean? Stock market comes down. The value, mathematically, we're not talking about how much money they're going to make in future. We're talking about how much will the future money be worth? You understand? This is a change in the money, the value of money. The value of money falls because the cost of money goes up or the inflation level goes up. If you want to use it inflation instead of interest rate, because you know there's correlated, the higher inflation level, the more interest rates, right? So you might say as inflation goes up, Think about it. If inflation's going up year after year after year after year after year for 5 years, what's $1 billion going to be worth in 5 years from now? $1 billion? No. You're thinking $1 billion in today's money. So what's the future? What's the future value of $1 billion? Right? What's $1 billion 5 years from now worth today? So that you're calculating, well, what's the future value? And if inflation is going up, what is inflation? Currency buys you less and less and less. You're like, wait, no, that means price is up. That's what I mean. If prices are going up and up and up, every single dollar buys less and less and less. So you could look at this as inflation or devaluation. Now, we might say devaluation of a currency, but we also happen to value a stock in a unit of account of currency. So the stock value has to fall. The expected return of a stock is equal to the risk-free rate of return, the 10-year T-note, right, plus the beta of the expected return of the market, okay, minus, okay, the risk-free rate of return again. So it's the expected return of the market, expected return of a stock. All right, so the other way you look at it is, what is the risk-free rate of return? Okay, RF is equal to the yield on the 10-year, okay, T-note. Okay, and I want you to think of it this way. Like, a lot of people get lost in, well, risk-free, 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 risk-free. All right, let's just say the expected return of a stock. What are you trying to say? You want to buy a stock, and you hope the value will go up. But if you analyze it and you think the value is going to go down, you're not going to buy it, right? So you're like, okay, what's a stock going to be worth in the future? The expected return of a stock. So now you're looking at one company. Then you're like, well, the risk-free rate of return. What does that mean? Think of it as your alternative, your opportunity. If you buy the stock, then you didn't buy this. And this, you're guaranteed your money. Okay, you're guaranteed your yield on the 10-year T-note paid to you by the U.S. government. And then at the end of the maturity, at the end of 10 years, you get your cash back. It's guaranteed. It's risk-free. So it's always an alternative for you. If you got some cash, you could buy a stock, but you're not going to buy a stock unless they compensate you for the extra risk you're taking, because you can just pick up the yield on the 10-year T-note. It's like right now, it's basically 2%, right? So you're like, dude, I'm guaranteed 2% right out of the box. Okay. So you're like, so you got to compensate me for that. So now you look into the next part of the equation. Okay. Well, what's the beta of the stock versus what? What is this? The expected return of the market. So if the okay, so let's go here. Right now you can collect the 10-year T-note will pay you 2% guaranteed. Okay, then you have to look at, what do you think the stock market's going to do? It's down 10%, but you might say, well, by the end of the year, you think it'll be up 10%. Okay, so you're like, okay, so you expect, right, the S&P 500 to go up 10%, but you got to subtract your opportunity cost because you would have made 2% anyways. So the higher risk will have to compensate you for that. So anyway, so now this drops down to 8, right? Because you got to do -2. And then you got to look at the volatility of the stock relative to the S&P 500. If the S&P 500 goes up 1%, does this stock go up 2% or does it go down 1%? You could have a negative beta. Or if the S&P 500 is up 1%, will the stock be up 1% or 1.25? Well, then it moves slightly more. There's slightly more volatility of this stock relative to the broad index. Long story short, you start jacking up, yields. It means, like, for example, this math is easy, right? Expected return of the stock market's 10%. You think the risk-free rate of return is 2%, okay? So your opportunity minus opportunity cost is 8%. But if the yield on the 10-year T-note goes to 3, now you're only pulling home 7. And of course, maybe as money gets more expensive, maybe this sucker only goes up 8. Okay, so now this drops by 5. You see, this goes up and up and up and up, and it lowers and lowers and lowers the value. So now the expected return of a stock in a world where interest rates and inflation are going up is down. So the stock market went down for 2 reasons. In January specifically. 1, math. And 2, seasonality. Cool. So let's tie all of this down to today. Okay? Let's tie all of this into today. We talked about what fundamental analysis is. Fundamental. Okay? Is the study, the trend, let's say trends in economics. Okay? And 2, the reason for it is to anticipate, spelling's way off today again. Anticipate central banking policy. And of course, then we put that together in figuring out the value of a currency, right? So in a non-reserve currency, like in a standard, normal, modern, mature economy that's not a reserve currency, okay, if you raise interest rates, typically that raises the value of your currency. And if you cut interest rates in a non-reserve economy, the interest rates, you cut interest rates and the value of the currency falls. Okay? So, what about NFP today? Well, typically what we say is, right, a good NFP is put into the data set analyzed by the central bank. Central bank says, oh my God, red hot jobs report in a red hot inflation report, okay, in a red hot growth environment, we must raise interest rates. And so the market will jostle for position. How many people would agree with this? And then the next thing is, what we don't know is, even if we all agree they're going to raise, by how much? And now market participants debate what's going to happen March 16th. We debate and we debate and we debate. And of course, we debate in the market with our money and our investments, right? So therefore, we would gather here today to see, is it going to be a good or bad NFP? But we don't actually care about that. That's just a data point in a data set. What are wages? What's the unemployment rate? What's the labor force participation rate? These are just data points in a set of data points. And then we do some math, y equals mx plus b, so that we can look at the y-axis, the x-axis, this, right? The change in the mean, which we call the slope, right? And then the intercept between axes to get direction. And then you can say, oh, the data set looks really good right now. That may lead the Fed to raise interest rates, and then we can debate on how much. Okay? What has changed this time? Why do I really not even care about today's fundamentals? It's fundamental, isn't it? Geez, I'm just off today. Mental. Why is it almost irrelevant? And sorry to downplay today. I know this is a big event. I've put my time on this, right? Okay. By the way, Arve, I have tremendous respect for you. Uh-oh, but here it comes. Here it comes. And on is the same thing. I really don't like that answer. I really don't like it. It's not you, it's me. I don't like that answer, right? Because people say that in almost, to me, it's like a hedge. You're not saying anything like, I don't know. I don't want to pick on religion, so I'm not going to go there either. But this idea, to me, that's not an answer, because then everything is always priced in, so therefore you never need to make a decision, right? Right? So it's sort of like, I don't know. I don't buy that as an answer. I'm asking you as an economist. I need the opinion, right? So anyways, is it priced in? Whatever. But here is the thing though, right? We study non-farm payrolls and GDP and inflation. Those are some big ones, right? And inside non-farm payrolls, we're looking at numbers of jobs weekly, numbers of jobs monthly, the trend in those things. Okay. Wage growth, participation rate, right? And how many of the jobs are part-time jobs and how many jobs are full-time jobs. And even some of the things I talked about yesterday in my private groups are things like the velocity of jobs versus the velocity of money. And it's important, right? And it all boils down to, what's the Fed going to do? We already know. Fed told us. Fed said March 16th, okay, 25 basis point hike. And what's the other thing they told us in the meeting minutes and congressional testimony? Steady. It's important. They're not going to pause. They're steady in the English language means the same over time. So 25 basis point hikes. For how long? Well, we don't care about that today. We can debate it, but we will have a much better understanding, okay, a year from now. May I have permission to continue on the fundamental plan? Because like I said, I don't care if it's 500,000 jobs or 300,000 jobs. It's already a done deal. Can I continue with sort of the longer term view here? Can I take this to the next level? Okay, so how far does this go? Okay, here's potential GDP. Well, let's do this properly. Let me do it this way. Here's potential GDP. If you go, and you can look on the Fed, by the way, okay, you can just do this. You can just ask the Fed. I can do it if you want me to. Okay, potential GDP, that's Y. And over 50 years, GDP in the United States grows by 2.2%. I can prove this to you. Just take my word for it. Okay. Okay, so that's average. Of course, sometimes we have red hot economies, and then we have recessions, and then we have boom, and then we have bust, and we have boom, bust, and we're kind of like here now. Okay, but we know if you average everything out, okay, it's 2.2%. So here's the thing. That's growth. GDP, okay, Y is nominal GDP. Okay, cool. So if you raise interest rates higher than that, so let's say interest rates equal 3%, you will cause a recession. Money, think of it this way, money costs more than it's worth to you. So I could argue, let's say over the next 3 years, interest rates, okay, like, right? Here's my argument. Here's my thesis. Argument sounds negative. It's not necessarily. Okay. Okay, here's my thesis. Rates in the next few years stay below, I'll say 3%. Okay. Now, like that's over the next 2 years. Okay. 3%. Okay. So let's identify this. My 2-year thesis. Let's be specific. My 2-year thesis is rates will stay below 3%. Now, as we go through time, I may have to adjust this because inflation might continue to be incredibly abnormally high. And therefore, something will have to be done. And it wouldn't matter because if you leave inflation high, it's going to cause a recession anyway. So who cares? You might as well control the recession, right? So there's that. It could go higher, of course, and it has been higher. But let's say, again, in the next 2 years, we will stay below 3%. Okay. So maybe, okay, in my 200th non-farm payroll. Is anyone going to attend that one? 200th NFP. Who? NFP. We can analyze through fundamentals what we believe, or at least revise our model for what the Fed needs to do as far as a target. We can revise our model because we want to know, how is growth? How is inflation? How are jobs? How are wages? What was the fourth quarter like? And we look at all the trends in the economic data, and we build a new thesis or revise our thesis that tries to predict the Fed's next move. Yeah, so I'm only saying nine months, but a lot can happen in 9 months. Okay? Okay. By the way, my swing trading group and I met last night, and we've planned out much of the year by creating sort of a mental model. Okay. And over the last week or so, we've been cornering the market on industrial metals. Because we're anticipating Christmas retail sales. Oh, nice. Good. As they say in Holland. Good. Yeah, good. And the swing, right? And the swing, though, Gary. So, guys, I have a day trading group and a swing trading group. There you go. All right. Let's go back here. Oh, good. Good. Huh? Look at that trade. What a liquor ding. Okay. That was more German. Sorry. Yeah. Sorry. Sounded German. Good. Good. All right. I want to go here, actually. Okay. Dollar strong. Swissy strong. Yen strong. Big risk off right now. Euro getting crushed. CAD doing well. Aussie doing well. Guess what? I'm buying CAD and Aussie. So far, so good. Why? Cornering the market on industrial metals. Pound recovering. Kiwi doing great. I planned, by the way, a 2,200 pip move on Kiwi. Boy, you should be in my groups, huh? You should join the live groups. All right. All right. So anyways, Euro getting crushed. Great. Great. What time is it, by the way? I got to keep an eye on that. No, we got 15 minutes yet. All right. All right. Don't let me forget. Cool. So Rabin's like, I've been researching the value of the dollar not pegged to anything. But it's funny because you can't have a currency not pegged to anything. What is this worth? $100. Well, if you're not going to buy something with it, then it's not worth anything. You got to peg it. How many Mountain Dew Zeros can it buy? Probably 150, right? This is worth 150 Mountain Dew Zeros. You have to peg it. If there's no medium of exchange, then it's not worth anything. Okay. But the petrodollar stuff, yeah. How does this affect energy complex? Well, all the petrodollar means is, right, the US dollar, because it's a reserve currency, is used as a unit of account for a barrel of oil globally. Right, so you could argue this is not worth dollars, it's worth a portion, well, in this case, a barrel of oil. Okay? Well, what's a barrel of oil worth? Depends on your use case. How much, okay, in that raw WTI or Brent, remember it's not actually oil, right? It's petroleum. And then it gets turned into things like jet fuel. So now you're like, well, if jet fuel is worthless, oil is worthless. If we stop using plastic, oil becomes less valuable. It's always pegged to something. If you can't convert nat gas and crack the nat gas and you can't create fertilizer, then it's worthless. So you might as well just burn it off. We're always exchanging. So I just want to pick on that, like not pegging. You have to peg. You have to peg. Because then if it's not pegged to something, it's not money. Okay? If, for example, I could eat this $100, it would be worth something to me. I can convert it into energy. Right? Lactose and glucose, for example, and fat. I can convert all of that into sugars, right? The starches and the fats get converted to sugars, and I convert the sugar into energy. Okay? So if I could eat this, then it would have value. But if I can't eat it and I can't exchange it for something that could then be useful, then this is worthless. So, okay, now what? Huh? Now what? You guys want to exchange this for something? Now my medium of exchange has been destroyed, and any intrinsic or inherent value, there's no inherent value, any intrinsic value, oh, here's some of it. Huh? Now I've destroyed the medium of exchange. It's no longer pegged to anything. And now it's gone from a potential value of 100 units of account to 0 units of account. No medium of exchange, and therefore has 0 store of value. It went from maybe being worth money to now no longer being worth money. So you got to peg. That's the whole point of money. Let's take a look at commodities. But yes, so anyways, for example, I want you to think of it this way with the petrodollar, Raymond. Saudi Arabia, okay, or how about this? Let's use geopolitics right now. Okay, the Western world decides to no longer buy Russian oil. They're going to punish the Russians, force them to end the war. And they're like, until you pull every tank and every soldier out of the Ukraine, Germany will stop buying oil. You have to remove every soldier, every tank, okay, and every plane out of the Ukraine, and then we will start buying your oil again. So instead, Russia says, well, screw you. We're going to sell all our oil to China in exchange for yuan. Oh, now we have broken the petrodollar. And that could lead to the process of a yuan becoming somewhat of a reserve currency. What does a reserve currency mean? It means all central banks in the world keep it on reserve because it's needed for the mechanism of exchange. So when Japan buys oil from Canada, it has to do it in dollars, US dollars, not Canadian dollars. So think of it this way. So Japan goes to the Bank of Japan and says, please wire this money in US dollars to this company because they're sending us some oil. So what the Bank of Japan does is says, oh, it must be in US dollars. This company has yen in their bank account. So the Bank of Japan just simply goes to their balance sheet. They already have a bunch of US dollars. Why? Americans buy cars and machinery and all this and computers from Japan. So when Americans buy all this stuff from Japan, they're putting US dollars in the Bank of Japan, and the Bank of Japan is paying Toyota and Honda and Mitsubishi in yen. So now when those companies say we need energy, or let's say other companies say we need energy, they're sending out their yen, they're selling their yen to buy the dollar, but the dollars are already in the Bank of Japan's vault, right? And then right? And off we go, and there's a conversion. So there's, because of the petrodollar, meaning all deals in oil all around the world, irregardless of the countries, are all priced in dollars, so there'll always be built-in demand for the US dollar. So every single country in the world, except Turkey and North Korea, okay, and maybe Venezuela, have US dollars in their vaults. And that's why it's a reserve currency. They all keep it on reserve because it will always be needed until there's an alternative. And if there's an alternative, it was supposed to be euro, by the way. And there was a time when all central banks around the world had dollars and euros in the vault, and the euro was becoming more and more of a reserve currency as central banks had to keep more and more on reserve because it was, you know, an alternative to the US dollar until the whole thing fell apart. And so now it's no longer a reserve currency, really. It's kind of maybe, but not really. It lost its importance in the world dramatically. But someday it will be yuan. It will, right? It will be someday, but not today. But you might want to track that if that catches your attention, Raymond. Okay. So let's go back. Let's just watch this on euro dollar. Okay. And, oh, wrong one. Okay, euro dollar. I'll clean this up in a second, but just bear with me. Okay. So, non-farm payrolls. Let me just clean it up now. Okay. Let's go to template blank. I'll put it back to blank. Okay. Non-farm payrolls. Here's price. And then non-farm payrolls might go like this. Boom. Okay. Standard operating procedure. The first part is the market set up, so we're only thinking long only. Now, if that's the case, buyers, okay, this is in my book, by the way, buyers either buy low or higher low. It's the only thing buyers do. They either buy low or they buy higher lows. So it would look like this, down, 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 down. And you get yourself a little buy zone. Pa-ching, somewhere in here, and you're thinking long. Market goes up, makes a new higher high. Okay, drop this over. Comes down, and pa-ching, pa-chang, pa-chung, pa-chung. Okay. Plan A, plan B. Now, if it goes up and does this, well, if you bought at A, you're going to take a small loss. Get over it. Or B, you just never get an entry and it falls without you. Don't worry about it, because this is simply a scalp, which I call a high volatility event-driven strategy. Okay? For short. So let's clean this up. I'm going to add monthly and weekly pivots, and I'll show you right now we're already done for the month. Based on historic norms, we're already done the month of March. Ish koputya. But do what you got to need, right? Do what you got to do, son, because this is complicated. Euro's getting crushed because of the situation in Russia versus the Ukraine. So there's that's going to crush their economy. The second part is dollar is historically strong, but only in the beginning of March. Only in the beginning of March. So it's supposed to be strong. But the second thing is, sure, risk off because of geopolitical risk for sure. So it's a double doozy. So this is a technical bottom in a fundamental world. Live in a fundamental world, and I am a fundamental girl. Okay, so you got to be careful. So you don't want to place too much on technicals, but we are technically near a bottom. So watch for the spike. 678. Thank you, Hervé. That sounds really nice. Why don't we get into it? But let's take a look on the smaller time frame and let it play. Okay. Live in an material world. Okay. So let me change the template again. Hang on. Template. Let's do some PA, man. Let's do some PA. Current printed bottom. Current printed top. See how it plays out. And I am my world. Okay. Okay. All right. Here it is. All right. Okay. Wow, look at that. Whoa, way before 4.0, man. Holy smokes. That's good. So I'd say we're at full employment now. Number of unemployment is 6.3 million people. So still 6 million people out of work, huh? Dude, I hate how they write these things. The unemployment rate for adult men or Hispanics. Jesus. If you're Hispanic, are you not an adult? Like, it's just strange. Oh my God. It's just so weird writing. The jobless rate for for adult women. Okay. Okay. Whites 3.3, blacks 6.6. Wow. Asian 3.1. So women 3.6. Whites in general 3.3. Asians, 3.1. So pretty much across the board, except if you're black and that you're really hit hard. 100% more unemployment than everybody else. Wow, that's crazy. By the way, I heard in New York City right now, people in the hospital right now for COVID is significantly low. But they said for whatever reason, the rate of people in the hospital because of COVID, based on race demographics, twice as many blacks than whites. And they're like, for whatever reason. It's just, it makes you wonder, like, what is it? Is there access to medical, living standards, culturally? Is it, I don't know. It's weird that it would be like that dramatically different. You're like, that, wow, amazing. But anyways, so you can see, like, basically every other group is between 3 and 4% unemployment. But if you're African American, it's double that. You're like, holy crap, that's a big difference. Okay. Among the unemployed, a number of persons on temporary layoff at 888. Really? That's interesting. 888,000, really? That's interesting. Let me do some research here. Challenger, Christmas, and Gray. They must have a... Okay, that's strange though. Okay, they only have cuts of 15,000. So where's this, like, million? See, this looks the opposite. So I don't know where this government gets that number here. That one looks strange to me. Number of person jobless, okay, we know that. Weekly jobless claims. Labor force participation rate. Okay, changed little over the month. So that's very disappointing. That should be a lot higher. So there's a lot of people that permanently lost their jobs and are not even being counted. Number of persons not in the labor force. Yes. Okay. Oh, okay. That actually went down. Okay. There's 5.5 million people on welfare. Okay, basically 500,000 people more than usual. Very cool. Anyway, so there's a lot of great data here. Okay, great. Great. Living in a material world. So what we're looking at is how price is going to react now to maybe a lower low. So I have this as a potential role reversal, as you can see. Okay, so the big question here is that. Thanks, MIA. Live in a material world. Go. This info you won't get anywhere else. Well, have you checked everywhere else, Men in Action? So, by the way, I pulled up the Challenger Christmas in gray. I realize I'm just thinking out loud. I'm not explaining. The Challenger report shows mass layoffs. So, for example, if a company lays off 1,000 people, it's not like you were fired. You weren't, okay? So it's determined as something else. And so I like to include that in my model. And it's not a normal thing to do. Most people do not put that in the model, but I do. Kim says average hourly earnings. Yeah, so yeah, I got you. That's not so good. And you want to look at wage growth, for example. Average weekly hours. So if you work in construction, you earn $32.27 an hour. Just watching it. What do you guys think of that technique I just showed you? Well, Obson wants to know if I'm going to place an order or not for you. So I did this, and I did this. I drew it out for you within 12 seconds of the lower low. So if that's not good enough for you to kind of consider and analyze and decide on, I can't do more for you. I'm not going to make the decision for you. I'm going to outline it. And you make a decision, but if you can't make that decision, not my problem. All right, so anyways, Euro getting crushed, which is the trend. I wanted to look at this one as well. Let's drop this into a 1. And let's take a look at this in scalping mode, if you will. And much different reaction here, which is interesting. So Euro is weakening, but I guess oil prices are probably down $10, huh? And that's what that shows you. Printed low, printed high. And we're in the mean right now. You know, this is sort of like a mean, right? So it'd be interesting to see what happens next. And even very little volatility on that, which is kind of interesting. Sure, there's options on currencies. I used to teach binaries. So let me back up here. Let me go to the Fiverr. I want to get rid of that. Really kind of more interested in sort of this area. Go back to the Fiverr. Really jammed in there. I'm surprised by that, actually. Quite surprised. Yeah, no, I know, but I used to teach binaries. But yeah, you can get options, sure. You'll have to go to an options dealer, much different than a typical broker, right? But yeah. Now, Black-Scholes were options on credit spreads to be particular. I don't have an options broker to recommend to you. You know, living in a Fundamental world, and I am a fundamental girl. Okay, so we also know we're at a bottom of a market, right? So let's look at this differently. Let me work over to euro dollar over here, and we'll do euro dollar here. I'll do monthly pivot points. Let's do template. Okay, position trading bearish. Okay. And, oh, that one's not set. So let me open up the indicator. I need to change this, and I want to add, I'm just adding midpoints. I'm not changing calculations to backfit. I'm just changing, plot midpoints, true. That's all I did. Okay. Okay, and what that shows you, okay. Let me zoom in here. Okay. Actually, let me just focus on today. So instead of 15 months, let's do 1 month. Cool, cleans that up. All right. So what we said on the first day of the month, even the last week of last month, we had this is the maximum logical target for the month of March as a bear. This is a bearish only template. Okay. Okay. This is right here. We're looking at, it's a sell zone. The trade plan for the month was sell up in this area here. And as a bear, your target is here for the month of March. Okay. Now, what I was saying before the non-farm payrolls release, this, okay, is a technical level. Okay, and it's market-based. However, this is not a technical move. That is a fundamental move. That's geopolitical risk-off move. And this can fall as far as it wants. All the algorithm is saying is, based on last month, if you look at the high, the open, the low, and the close, and you do some funky math, you'll say, based on what happened in the last period, we expect something like this to happen in the new period. But this month is not last month. Something unusual is happening. And so that can do something much more. It can fall much more. But these are levels that people are probably likely to also know. And their algorithms may still have those programmed in, or their eyeballs are staring at the same price that we're staring at. That green line is the projected low for the month of November. Basically 109. Oh, look, it's 109 right now. Okay. So it's an important level, but I wouldn't bet the farm on this going up, but that's what that says. Okay. This says all the bears should consider buying in this zone right here. This is a bearish buy zone. Now I want you to think about that because you're thinking about correcting me. Okay? You're like, what do you mean? Oh, no, Wayne, you mean bullish buy zone? No, I do not mean that. I mean precisely what I'm saying. This is a bearish buy zone. Okay? So the risk, like this would be a terrible place to sell now. Now you're way out of position. But this is where it could pop. Not that it will, but in a normal market, I would have pretty high conviction for green candles all of a sudden. Well, we're not in a normal market, and so now I'm like, dude, this is just be careful is all that I'm saying. Just be careful. Okay? So we have the lower low breakout, sell, lower low, right? Roll reversal, sell. I got to mark this one now. And what you don't see on this chart, and I'm just going to mark it with a little tiny X. Okay, that's the exit zone X that I just talked about on the other chart, right? So now what? Now what? How about this? You ready? Anybody here want to be a bull? I'll explain how. I'm not here to tell you to be a bull, but if you want to be a bull, I can tell you how. No? Okay. Fair enough. Trap it and wrap it. Okay. It would look something like this. I'll give you two potential trades. Or okay. Let me explain, Lucy. Let me explain, Lucy. Okay. First of all, it starts with bears buying. Why would a bear buy? They're taking profit. The second opportunities are for bulls to buy. So what do bulls buy? Bulls only do one of two things. One, double bottoms. Okay? And two, higher lows. That's it. If you're doing something different, you're not a bull. Now, bears sell double tops and lower highs. If you're doing anything other than those four things, you're not a bull, you're not a bear, but that makes you a pig. And pigs get slaughtered. Okay, so let's outline this. First one would be a double bottom. Okay, if you want to, you could consider it. Now, of course, if it falls further, you take a small loss and you call your mother and she'll hug you and tell you you're still special and everything's going to be all right. Okay? The next one is, right, so let's mark this. This is a double bottom and it's an acceptable trade. The second one is higher low. We also call this a roll reversal, an RR. What used to be resistance is now support. Okay. Now, the next one is we just simply get the higher high, higher low. And that's also acceptable. Both are higher lows. If you use a stop loss, make sure your stops are reasonable and that your limits are bigger than your stops. And you will be right as rain. Everything will be good. Okay. And in 40 years you can buy your Aventador. One of them, an Aventador Spider, drove past my house the other day. My wife and I were just in the front yard, and we were just talking, sitting on the stoop. And all of a sudden I hear this car going like 3 miles an hour at 7,000 RPM. I'm like, oh snap, what is that? And then you can hear he puts his foot on the, right, whatever, if it has a clutch. I don't even know if they have clutches anymore. And all of a sudden you hear this, it's only going 3 miles an hour, and you hear this pop, 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 pop. I'm like, oh shit. What the hell is that? And it was an Aventador Spider. Yeah, I'm like, yep, all right. There's a Forex trader somewhere. And I'm like, dude, the guy's going 3 miles an hour, 7,000 RPMs, and pop, 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 pop. My wife's like, is it broken? I'm like, no, dude's like that. That's what you wanted. That's why you buy an Aventador. You want to hear that pop, 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 pop. She's like, sounds broken. I'm like, I know, honey. I know. Okay. Now, of course, if you're a bear, you're going to probably take a different sort of angle of attack, right? So I asked you if you want to be a bull. Okay. No, Alfredo, I didn't say guys are trying to, why buy the dip? What I'm trying to point out is 10 days ago, I'll make up a number about that, right? 10 days ago, an algorithm that analyzes the previous market suggested this price was important. Okay? Alfredo, that's my only point. And that price should be, that calculation should be included in your model. Now, you might do all of that and say counter trend. So I have a model that says if you hit this price early in the month, which once again is subjective. Well, what does early mean? I don't know. What does it mean to you? But I do have a model in normal market conditions. And of course, this is an abnormal market conditions with geopolitical risk. But nonetheless, in the standard model, if you hit that particular price, and notice it didn't even go 1 pip lower. It might in the future, but it did respect that price. Okay. So the second thought is in a normal market, when you hit that price and it's early in the month, one of the things you can expect is a counter trend to develop. Okay. So for everybody that trades with me every single day, what is the target if this counter trade setup sets up? What is the target? Oh, sorry. Yeah, I've been getting that. Sorry about that. Yeah, I'm trying to get this lower. Also, I think this mic got put on a little hot too. Let me turn that down. That might be better as well. Thank you, Corey. The target is the central pivot point. Correct. Okay. Yeah. All right. Thank you, guys. What a glorious day, man. Been a long week. I don't know about you, man. Long week. Go back to the basic one or the previous. Dude, I can remember everything. Okay, moment of truth. MOT. Okay. I can't tell what's true or dreams. Deep down inside, I hear my screams. But the terrible silence stops me. Okay, I want to look at next week's plan. And it still looks good to me. Bum, 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 ba, bum, bum, ba, bum. Bum, 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 ba, bum, bum, ba, bum. Ba, ba, bum, ba, 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 bum. Just marching like a stormtrooper. Okay. How much of the monthly percentage profit? Okay. 2 to 3% is the ideal target. Sometimes more, sometimes less. Okay. And you will note that those calculations mean my lot sizes are tiny. 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 Okay? Well, your drawdown would be relative to that target, right? So most professional investors have a very, 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 very small tolerance for loss. Okay? So for how loss, like a bad month would be slightly positive. If you lost 10%, you are invited on a free trip to Dubai. And they're like, we'll pick you up at the airport. And so they pick you up in a black SUV. And you're like, wait, why are we leaving the city here? And they take you out to the sand dunes. Well, you probably get the idea for the rest. You're like, wait, this isn't the Burj Al Arab. This isn't the Burj. Where are you taking me? Yeah. Oh, thank you for coming in and insulting me, David. Yeah. So what, actually, let's go there, David. David. Okay. Okay. What part is awful? Are there too many indicators? We can do a couple of changes here. Okay. Because a lot of that is really unnecessary, of course, as you're probably stating. Okay. What else? Too many moving averages? Yeah. Yeah, let's work it out. No. Wait. Don't don't attack David yet. Yeah, yet. Don't. No. Like let's clear. I'll adjust. I'll see if I am here to help. I'm not here to say I'm the best trader and that my way is the best way. That's not my message, right? Okay. Yeah, I got you. So I'm a macro trend trader. So I look at central banking policy, global money flow. Okay, I look at seasonality. And now on here, I'm looking at technical analysis. Okay, so I'm not just looking at this chart and making decisions. That's true. Oh, so you're here to tell me that you are better. Oh, I see. And that you're fixing one of the people I've trained. Oh, well, thank you for that. Oh, okay. Well, now you're actually being rude and attacking. So it'd be nice if you just left. Yeah. Well, no, if you're helping him, then that's great. But there's no need to take over a webinar. All right. So let's look at this. So on the short run, technically, okay, this is our buy zone where the gap opened. On Sunday, the weekly target was here. And now what I'm looking at for next week, which I covered yesterday, is down, 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 and up, up. Okay. So that is actually what I'm looking at for next week. The challenge, of course, and now let me kind of clean up the monthly pivots here and get rid of last one because they overlap a little bit, right? So is it month bullish mode? Oh, wrong ones. Bias pivot, new pivot, monthly. Yeah, let's just do this month and get rid of last month. There. And it's easier to see, like, unfortunately, it's such a close target. So usually weekly, you'd be targeting way up here, but we have a caution. If you want to look at it that way, this is a caution area. This is, again, based on last month, which is not a good measure of this month because this is an unusual month. But it is telling you that that's a level of caution. Once you get above 74, even though your weekly says 75, 74 and change is like a warning sign that the market, based on what happened last month, is becoming overbought. Okay, you see? So you could do something. I'm not recommending this, but when you're in a situation where you're like, and actually we did this with one of the other currency pairs, a couple of currency pairs, and I forget which ones now, but let's say you analyze, you make a decision. That's all I'm teaching you is all the different things that you might need, or many of the different things you might need. Okay? Like David was saying, like, order flow is important. Open interest is important. Sentiment, sure. Sure. Okay? So you can consider those things. I'm not here to say that those are wrong. Okay? I look at a bunch of other things. Okay? That's fine. Right? The most important thing is you have a methodology of making a decision. So you could say, based on last month being a usual month and this month being an unusual month, and you're more interested in the shorter term because of, let's say, an increase in volatility and in many cases a lack of trend, and in other many cases like euro getting punished, other things over trending, you want to look at shorter time frames, right? You want to look at the shorter time frames. So you could make a decision, for example, you go to your indicator list and you're like, okay, I see monthly coming up and it's saying be careful, be careful, be careful, but man, we got a runner right now. So you delete that out. Oh, and that didn't delete out. Indicator list. I don't know what I deleted. There we go. And you stay daily and weekly. You see? Okay. Okay. Oh, it's not too many indicators, guys. You got to look at each piece. So again, like you're like, look at all those lines. What do they all mean? Well, look, I'm not looking like, let's go to here. You know, I'm only really kind of looking at this and then a little bit of last week, but let's just do it that way. And I drew these lines. They're not even indicators. They're lines. I drew them because they're breakout points. So, okay, these are like, it broke that, so you buy here. You see, it's not complicated. Don't get caught up, oh, there's so many lines. Well, a lot of this is old analysis. These are old trade plans. Look, buyer here, okay, breakout, buyer here, okay, right? Buyer down in there. These are just old things. So I'm spending most of my time, in sort of the now. So I see this dip, that's a buy. Okay, I see this dip, that's a buy. I see this dip, that's a buy. I see this dip, that's a buy. And now I have a warning sign that for this week, I need to be careful because it's overbought. This is where many bulls will sell, meaning they'll take some profit. I don't really expect bears to sell here because remember what I said bears sell? What did bears do? Bears sell what? Double tops and lower highs. So this is a higher high. Bears would not sell that. That's it. A bear would not sell that, but a bull would sell that because that red area means take profit. Okay, now a bear would sell this, right? A bear would sell that. Well, that's a double top. We're not at a double top, so I'm not that point, right? So I'm more like, okay, a bull is going to buy a dip because it made a higher high. So they're going to take profit here, but they're going to buy what? A higher low. And that's the plan for next week. Now, all of that will change technically, of course, if you get something like that. And when you start doing things like seasonality and fundamentals and macroeconomics, and maybe even things like sentiment, although I find sentiment a little bit slow, and open interest and stuff, okay, fine. Okay, fine. That's great. Your job, no matter what indicators and tools and analysis that you're doing, what you're trying to do is understand where this may occur, and in particular, technically, that it has occurred. Right? Yeah. Alrighty. So all set. Very nice. Okay, very nice. Actually, I want to watch this one a little bit if you don't mind. Oh my God, too many indicators. Okay, let's try this. Let me switch this up. Where should we put this? Oh, why don't we do this one? Pachow. Let's take a look. Pretty stuff, huh? You can add to this. I don't know if I can with this color scheme. Well, let's just change it in the template again. Let's go to let's take a look at here. Okay, we're caught between two annual pivot points currently, which I think is kind of interesting. Okay, you can see that there's very little trend. So what it's looking at right now is sort of, this is a top-ishy area, this is a bottom-ishy area. And and one kind of interesting piece of information is the old central pivot is here and the new one is there. So it is suggesting over this longer time period, of course, because this is weekly, that we're looking at a trend towards Canadian dollar strength. Let's take a look. I'm looking at, like little pieces here, right? Little pieces of how price is behaving. So what you want to do is kind of connect, all that kind of stuff. And then what's interesting, I think anyways, this is a yearly M3. This is a yearly central pivot. So we're pretty early in the year, obviously, and we're just coming to a conclusion of the end of the first quarter, which is typically not a great quarter anyways. It's the beginning of the quarter ends with profit taking, rebalancing, and such. And then going into the second quarter is more of an allocation quarter. So I've been buying the stock market the last 2 or 3 weeks, right? In particular, a month ago. Then I took a break for a couple of weeks, and then just recently been buying again based on my anticipation for the second quarter. Okay, again, things like seasonality and some other reasons. But it's interesting that if we were to like summarize what happened in this first quarter, where generally this is a sideways quarter, you can say, well, all we did is kind of test the central. And then all we did was kind of like multiple times test the M3, but by and large is non-directional. And even you can see even the midpoint is even been supportive, which is, somewhat of a lack of direction, right? Right? And so now what you can see is these are important price levels, right, for the future. Now, if we go out further out, this is where your bias comes from. Do you think the US dollar is going to get strong? Let's not even talk about Canadian dollar. Let's talk about the US dollar, the largest economy in the world, and then the reserve currency of the world. Do you think the US dollar will get strong throughout the rest of the year? Now, if you say yes, you are saying this. Okay, let's do this. If USD up, you are saying stocks down, yields down, stocks down, yields down, and recession. Okay? Simple enough. And that would negatively impact the Canadian dollar, weakening it. Why? Well, the United States is Canada's largest trading partner. So if the United States is in trouble, Canada is going to be negatively impacted. Also, that would eventually bring down energy prices and other commodity prices like grains, metals, okay, energy, all that, right? And Canada has a lot of that, but if all those prices come back down, that would negatively impact the Canadian dollar. So if the dollar's strong anyways, because all of these things are happening, they would also negatively impact the Canadian dollar, and you would go this way. Okay? Does it, right? Do you guys think that's realistic? Of course, it's possible, but are you modeling the next future year based on that? Okay? Okay. So, okay, if that's what's happening, then that's how you put together sort of trade plans. So if you are a bull on this, you would say you buy at the bottom or you buy at higher lows. Simple enough. So you identify this as support and you identify that as support. Okay? So you could buy here, which is long gone now, of course, but then if it breaks, you can try something like that. And if it breaks this, you'll try up here again. Oops, wrong button. Hang on. Uh-oh, what did I click? There we go. Or you buy here. Okay? And off you go. Okay? So, I believe under my current analysis, the opposite. The USD will weaken, which means stocks will rise, bond yields will rise, okay? Bitcoin will rise, housing will rise, okay? Trade with Canada, Canadian trade, okay, will rise. So let's talk about that. GDP is equal to consumption plus investment plus government spending plus exports minus imports. So, the United States, USA GDP. Okay? The United States does well. They're rich. The economy is recovering. There's lots of aggregate demand. Prices are high. So, in terms of in units, let's say, in units of imports units will go up, but in terms, right, M per unit, so more barrels of oil than before, more ounces of gold than before, more bushels of wheat than before, more pounds of beef than before, so on and so forth, right? So in terms of units, it goes up, but then there's inflation going on. So M goes up even more in terms of dollars. Okay? Because of inflation and high prices, you need more dollars to buy the stuff. So in terms of dollars, it goes up even more. So the United States then imports a ton of stuff from Canada. It comes into the United States and out of Canada. So Canadians are selling their wares for Canadian dollars, not US dollars. So the United States exports US dollars, okay, USD, exchanges them for CAD. So demand for Canadian dollars goes up, and the supply of US dollars goes up. Therefore, the value of the US dollar goes down, so USD down, as a direct result of the import-exports. So the United States is exporting US dollars, converting it to Canadian dollars, and then buying oil, gold, wheat, or whatever. And then the Canadians put that on a train, plane, or automobile and send it to the United States. So the United States buys wheat, and that's imported. In exchange for that, the United States exports US dollars, buys Canadian dollars, and pays the Canadians. So therefore, demand goes up for the Canadian dollar, and CAD goes up. So, long story short, because of the flip side here, okay, what happens is the Canadian dollar will weaken. Sorry, the Canadian dollar will strengthen, the US dollar will weaken, and that would look like this. And you're like, but Wayne, that's not happening right now. Cool. Then you wait. Okay? So, going to Barb's question, it has to do with aggregate demand. So, what I'm trying to get to is, in the United States, when the stock market's going up, okay, and let's say when housing goes up, your retirement account and your largest investment, they're making money. You feel really good. Things are good, which therefore means that GDP is going up. There's growth. Why? Because people have jobs, which then leads to wages and spending, and savings, which leads to investment, which leads to an increase in productivity, which then means increase in efficiency or per unit production, which makes companies more profitable, which actually is disinflationary. Okay? And therefore, stocks go up because of the increase in expected future value. Remember, the present value, the future value is equal to the present value over 1 plus I to the n. So the increase in productivity either lowers prices or increases supply, which therefore lowers prices, which lowers I, which makes this better, which therefore the stock market goes up. And because everyone has jobs and everybody's rich, because TVs are getting cheaper, phones are getting cheaper, but they're also getting better TVs, better phones. Okay? So anyway, so everyone's feeling good and everyone has a job and people want to get out of an apartment and rent and buy a house and live the American dream and all that kind of stuff. And foreigners are coming to the United States to get good, better work, and therefore they're the ones moving in, paying rent and all that kind of stuff, right? It's all good and very productive. And when that happens, aggregate demand goes up. Aggregate demand for what? Houses, rentals, TVs, phones, food. And in particular, you might see a change like a substitution effect. We were talking about this the other day at FX Bootcamp, where in a recession, you buy lower shelf alcohol, but you definitely buy alcohol when times are bad because you're like, life sucks. So you go to the liquor store to drink your problems away, but you ain't got no money. So you're like, you buy some cheap vodka. But then things change over time and everything's good and your company is going to IPO and you think you're going to make $1 million. What do you want to do? You want to go to the liquor store and party. So you buy top shelf alcohol. And by you, I mean aggregate, right? So aggregate simply means everybody and everything. So you might change some of your spending habits, but productivity, like GDP, doesn't care if you buy cheap vodka or expensive whiskey. It doesn't really care. But the thing is, you're spending and buying and all that kind of stuff, right? And so long story short, and I had a long conversation with one of my economics professors at Harvard about this because I argued over gold specifically. And his argument was when aggregate demand goes up, it goes up for everything. That's what it means, aggregate. Now, I kind of looked at it as, I looked at I separated demand into something different. I don't know how I was looking at it, but you want to this idea, maybe you break them apart and you're like, okay, from an economic level, will everybody benefit? And the degree to which everyone benefits from the economic condition or is hurt by the economic condition, because demand could be going down, then the demand for everything will be affected because we're talking about everybody in the economy. We're not talking about the 1%. Okay? So his argument was aggregate demand will push up prices for gold. And then you're like, well, what about inflation? And what about this? And what about that? I thought it was a hedge. I thought it was a flight to safety. I thought, well, that might all be true too. But in some degree, when everybody is being productive and everyone is being rewarded for their productivity, the standard of living increases And they will buy a little bit more of everything because everybody has a little bit more to spend. And spending is equal to saving. Okay? Well, spending is equal to savings, and savings is equal to investment. Okay? And that's important. You guys follow that path? Your spending is somebody else's income, and excess income gets saved and turns into investment. Why? Well, either you decide to save it by putting it into your retirement account and buy some mutual funds, and that's an investment. Or you decide to save money and convert your savings. Remember, you have to be able to exchange it, otherwise it's not money. So you save it so you can buy in a house, and a house is an investment. It's actually, that's where housing fits in GDP. It's under I. Now, usually I is businesses. It's business spending because businesses don't go on vacation, but they buy plants and property and equipment. That's an investment. But your house also is an investment, and it falls under that. You can actually look it up. You can download GDP from the government website, and the housing industry is included under investment. But you might just put it in a bank, and the bank loans it out to mortgages for somebody that wants to buy a house. Cool, right? And a poor country doesn't do that, and they stay poor because their savings don't get invested. They sit in a coffee can. Okay? And that's why they stay poor. How do you model that? Potential GDP. Okay? And the next part of this model that's very important is how much you invest. Actually, that's a no. I gotta shift this. Let me redo this. Hang on, bear with me. Okay, GDP, and this is investing. Let's see if I can do this right. Okay. And so the next thing so this is GDP. This is investing. Now, when you build things, like let's say you buy a house, you spend $1 million on a house, so you invested $1 million. But if you want to look at it year over year over year over year, every single year your house that gets less and less nice. Let's say you never mow the lawn, because that costs money. You have to buy equipment and fuel and fertilizer, and you have to pay for water. Okay? And you have to trim the plants and the bushes. Okay? But let's say you don't do that. Everything's overgrown. You don't paint the house. So now it starts to fade and peel, but also now the windows are not sealed, and the windows start to fail, and water gets in, and the roof needs to be replaced, and you decide not to do that. We call that depreciation. So you have this depreciation level, and some countries are like this. Okay? And what this leads to is not potential GDP. This is GDP star. What will happen is GDP investment is greater than depreciation. And so productivity goes up, goes up, goes up. Now you have less and 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 less. And now you get to this point right here. Okay. And at this point, you're paying more money just to keep your broken down bridge. But you need a new bridge, but you can't afford a new bridge. So you're just sort of duct taping the bridge, but eventually the bridge will fall. Okay? Okay, you see? So at this point, it's a key point. Now, the reason I bring this up, because this is called depreciation, and this is investment. So if you put money in a coffee, you save in your savings are in a can. you put it in a can versus savings in a bank. A bank will take that money and buy bonds, treasuries, or convert them into loans and mortgages. And for those things, they will earn a return on investment. The money is productive. I gotta fix this. The money is productive. Your money that you're saving gets put in your neighbor's house, is made to a company down the street so that they can buy inventory, sell it, get cash, pay off their expenses, and it's a normal part of business. So the shoe store down the street gets a loan, your neighbor gets a mortgage, the bank buys some bonds, and maybe it's a corporate bond, so that's great. The corporation gets basically a different type of loan. And meanwhile, they get paid a higher interest rate than their borrowing costs, because the borrowing cost comes from their depositors. So they pay the depositors 1%, they charge the mortgage 4%, they clear a 3% spread. But the thing is, investment is higher than depreciation, which means, so now if we do this differently, okay, investment 2 is higher. Okay, so this is investment 2 is higher. Then what happens is the steady state, well, a couple of things. You're more productive. So this is GDP2, GDP2. Okay. Okay, everything shifts. Okay, now your depreciation honestly will shift too, because you just have more stuff. So the slope of your depreciation curve. So now you got to shift that. Okay, whatever. Now you get here. And long story short, your new steady state is higher. And what does this mean here? Standard of living is increased. You're more productive, so there's more stuff for everybody. Or because you're more productive, prices are lower for everybody, and everybody has more excess money to eat better food or travel more or take care of grandpa in a nice retirement home and not have him live in a cardboard box behind Starbucks where he can eat day-old, muffins. Okay? And you're right. And the key point now is the steady state has to do with the point in which you've invested all your money and now all your leftovers are going back to pay for repairing the stuff you already got. And you can't afford newer stuff and more stuff. You're just paying for what you got. And so you must save. If you save in a can, your steady state is much lower, and you will have a lower standard of living because savings are not productive. And this is why we have inflation right now, because we have we put in about, in my calculation, $4 trillion in the United States recently because of COVID with zero productivity. And if savings is equal to investment, right, or spending is equal to income, now we can get really philosophical and you can think about this for a while. S is equal to I, or S is equal to I. And then you're like, well, wait, are they the same thing? No, savings is equal to investment, spending is equal to income. But then you're like, but wait, there must be a connection to all of this. And now, oh my God, now you're really clicking into economics, and we can get jiggy with it. But the idea here is some countries are really good at this, and some countries are not very good at this, and some countries are absolutely horrifically horrible at this. And what you do is you can go through all the math, and a lot of this is calculus, but you can go through all the math, and what it means is your standard of living is lower or higher based on how well you do this. So if you live in a country and you don't trust the bank, do you think your country is rich? Do you think your standard of living is high? If you can't trust your banking system, you probably live in a poor country, and you probably have a lower standard of living than a country that you can put $1 million into a bank and be assured that that $1 million stays there. In Argentina, people had retirement accounts, and one day they woke up and the government made an announcement, oh, we took half your money out of the banks. Sorry about that, by the way. Can you imagine you saved $1 million, it took your whole entire life, and then you wake up one day and you're like, sorry, you only got $500,000 in your account. You're like, what happened to my other money? Oh, we took it. Thank you very much. We appreciate it. Okay? So in that case, you stop putting money in the bank. So what's the next step? Less savings, less investment. Okay? Right? With less investment, you still got stuff that depreciates, so all your stuff starts breaking, and your steady state slides more and more less down, 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 and your standard of living falls. Uh-oh. I think my mouse is dying. Okay. Cool. Was that too much? That's too much. I went too far? Sorry, I was geeking out there. Going for gin, Arve? With the dingleberries? What's that berry that the Norwegians put in a lot of food? What kind of berry are those? Anyways, I can imagine. I bet you Norwegian gin would actually be quite good because of the botanicals you'd put in there. Okay. Ah, yeah, that's got to be good. Lingoberry, yeah. Einerberry, yeah, cool. Or juniper, sure, yeah. Cool. So you're saying I did geek out too much? I geeked out too much? Yeah. Okay. Cool. Well, there you go. Back to reality. Oh, there goes gravity. Let's take a look at some exotics. Okay, take a look at some exotics. Obviously, dollar is strong. Okay. We have a breakout. Okay, and you can see the old cluster of support that occurred in here. So you just kind of, I like to look at things as zones. But that's definitely a breakout, right? So what have I taught you today? Bulls buy, okay, bottom. So here, 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 here. Now, of course, you might say, well, dude, what about this? Yeah, that's a real problem for sure. So you could ignore all that. It's just you could, not that you should, you could, because you're like, well, Wayne, how do you know, for example, that it's going to go up, up, and then break and not fall? Well, you don't. You do not know that. Now, you might have a fundamental bias or some other rationale, but technically you don't. Okay? You'd have to add and incorporate other information. For sure. Okay? So the next thing that a bull could do is what? Higher lows, right? What we call a role reversal, and that would be this right there. Someday. Okay? That's it. And you're like, well, Wayne, that was quick. That wasn't quick. Okay, you have to go back in time, and that same analysis that I just showed you on a 4-hour, that's what it looks like on a 15. Okay, so how do you trade that? Well, if you're a bull, now this is your higher low, your bottom, and now you're thinking about the next step here of whether you're going to do that. But this bottom, you have to understand how time frames work. This bottom is the 4-hour higher low. So on a 15, you're buying a bottom. On a 4H, this is a 15M. On a 4H, it's a higher low. We call that fractal geometry. Oh, yeah, I generally don't use volume. I use time of day, which, you know, there's assumption of a volume in that moment. Plus, this is only giving you a volume of our liquidity partners, okay, which would be generally accurate. And Trader's Way has quite a bit of liquidity partners. I've seen, you know, other brokers, for example. I've compared apples to apples many times. And in particular, in lower liquidity periods, like a Sunday open, I see that the Trader's Way prices are moving up and down, you know, several times a second. Where then I'm comparing another broker at the exact same time during a period of lower liquidity, and it might move once or twice a minute, where you can see supply and demand through the liquidity partners at Trader's Way is excellent. And then you look at the other broker and you're like, dude, not good. Okay. But this volume is only as good as your liquidity partner. So one reason I might not use it, okay, going back to Pasha's question, is, you know, we all might have slightly different data, although during a period like this, it'd be probably quite similar because, you know, it's trading well and the volume is high. Also, just sort of as a footnote, 20 years ago when I first started trading, things were much different. Forex was much less liquid. Okay? The depth and breadth of the foreign exchange market was significantly smaller. For example, we're probably now, I haven't looked at the international banks, BIS, but the Bureau of International Settlements. Okay, they're the central bank for central banks. And I haven't looked in a long time because it doesn't really matter that much, but I bet you we're at $6 trillion a day volume. When I started trading, it was 2. So you can see right? That we're like 300% more liquid, if you want to look at it that way, than we were when I first started. So when I first started, and it's not a bullshit excuse, I'm just kind of like, where do I come from and what is my history? This would have been very unreliable, if not downright just wrong. Because my broker would be different than your broker, would different from the other broker, and it wasn't a volume play. Now, volume is very important maybe in futures and trading stocks and many other asset classes. But because there's no exchange in the foreign exchange market, but instead an interbanking system, basically every bank has its own liquidity, therefore its own volume, and therefore we're not comparing apples to apples. Maybe it's less important. But now that we're in a $6 trillion a day liquidity market, they're probably about the same. And I tend to trade around market opens. So when you join FX Bootcamp, we spend a ton of time on market open because we anticipate new volatility or liquidity, or what you would call volume, an increase in volume around market open. So like here, like just looking at this chart, okay. Just looking at this chart, you're like, look, here's a market open. Here's a market open. Here's a market open. Why do we care about these things? Anticipated increase in volume. And that in between these markets, there is a decline in volume. And so very often what you might think of is like an increase in volume leads to a trend, then everybody takes profit, and then there's a decrease in volume. And then maybe an increase, and then a decrease. So it would be redundant. But again, really falling back on my experience, it just was not something that you would have used 20 years ago. And in many brokers, I don't even think it was available because, again, there was no exchange in Forex. There is no exchange in Forex. Your broker is your exchange. And the broker then ties into liquidity partners, which make an exchange, but, right, like your London broker versus a South African broker versus a Hong Kong broker would have different liquidity partners and therefore different volumes. Whoop. Okay. So dollar up today, Bitcoin down today makes total sense. Drop into a smaller time frame. Okay. And you'll probably expect under these current market conditions, of course, they could change now that we've had sort of NFP and everyone's had a chance to digest. We can go from dollar strength and dollar weakness, but that's going to be your call, and that'll probably have a lot to do with the stock market's reaction. In fact, why don't we do that now? Let's do that. Let's use FXStreet for this, since there are wonderful hosts. I think we can get some S&P 500 on this, right? Live charts, dollar. Let's look at this. Thank you, MIA. Oh, burned is now long. Okay, so what you want to do, the reason I'm bringing this up is we're looking at the S&P 500 on FXStreet, essentially to say, how are market participants in the stock market reacting to, let's say the headline news? Okay. And if the S&P 500 wants to go up today, that would be risk on. Okay, stocks up, bond yields up, or I should say treasury yields, is really what I'm talking about, and Bitcoin up, and US dollar down, and Japanese yen down, and Swiss franc down. and pound up and Aussie up, so on and so forth, right? So you got to be able to pack them and stack them. And at some way I want you to decide, okay, the one decision. You can boil it down to like risk on or risk off. What's the plan, Stan? I don't know. Well, now you don't have a trade plan. But if you can decide, you're like, oh, looks like we're going to go up today. Therefore, now you got 8 decisions, let's say. Buy Bitcoin would be an interesting one, right? Okay, so now we're on a 15-minute chart and we're looking at this. So what could you do? And you identify a level of resistance and a level of support. And what are your 2 choices if you're bull? Buy the double bottom or buy the higher low. And if either of those things happen on the S&P 500, well, now you open up your Bitcoin chart and you're looking to buy either a double bottom or a higher low, or the next higher low, or the next higher low, or the next higher low, and the next higher low. How do you turn it back to price? Nothing compares to you. Oh, is that right, Master Trader? That is cool. You're saying a double bottom first? Is that what you mean by 2V? So I forgot how to change. I don't know how to change this back to price. I clicked logarithmic, then I did percentage. Maybe I just hit refresh, huh? How about that? That's an easy way to figure it out. Yeah, that's fine. Yeah, it still ends up being a double bottom, right? You basically left and right. Yeah. All right. So yeah, we're at 43. Yeah. All right. Add auto trend line, moving average, MACD. I just want to draw. How do you do drawing? Add an indicator. I don't want indicator. Show high last value. No. Nothing compares to me. Set the 0 point. No. 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 Oh. Yeah. Obvious. Officer. Oh my God. Okay. I guess we can kind of look at that area. And we could probably look at this area. Oops. Of some level of importance. Okay. And just see what happens. Okay. So remember, like this from a bearish point of view, what I've taught you over and over and over again today. So you would trap this and you see the lower low, and then you design wherever you believe resistance is. You might have captured these wicks. Maybe you're trying more like bodies. There's no right or wrong. Okay, so you could say bodies, top of the wicks, bottom of the wicks. The thing is, if you're a bear and you notice the lower low, what are the two things a bear can do? The first one is sell it up here. The second one would be to sell it here after the breakout retracement. So you would do all of this as a bear. Now, of course, if it printed this and went up and down and then up, right, then you're probably no longer a bear. Now, this is going to be challenged, of course, but eventually a bull is going to try for that. So that's why you kind of like, you got to put things into pieces and say, I can't be a bull, I can't be a bear. Okay. Okay. This would be a terrible place to sell. It's also a heck of a gamble if you're a bull. Why? Right? I want you to think about this. Why is that a gamble? That is a lower low. And I've told you over and over and over again today, bulls do not buy lower lows. So that's bears taking profit. And this is bears trying again. And they'll try again here in the future. If it does that, it's always an if-then, right? An if-then. Right? Now, Pastor's like, hey, well, not until there's a double bottom, right? So what if you got something like this later today? Could you trade this bottom? Yeah, you could. You know what I would rather do is let it break, let it pull back, and take that one. But whatever, to each his own. You can. Double bottoms are fair game. Roll reversals are fair game, and that's why this is trapped. That when I trap things, that's what I'm looking for. Okay? Now, you might have this trap differently. You say, I'm going to trap it here. That's just probably a higher time frame. But I got you. You're not wrong. Okay? And I'm not wrong either. But, you know, look, that's the bigger play. That's the smarter play. That's the more, you know, realistic play. Okay? But that means you're not likely to get a trade today either. But inside of that, you might play it like, if we ever kick off of this, I'm getting in the game early, because you're trying to play some sort of, you want to be kind of first in the game, right? So you'd say, well, if we get up there, then we hold on that. Now you got your inverse head and shoulders. Okay? Okay? So you're like lower, low, lower, low, 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 right? And you got this as a shoulder, that as a shoulder, and that as a crown. Okay. Now, right now, the S&P 500 is coming down hard. I would think dollar is strong. I would think Bitcoin's coming down. So this line in the sand matters. It could determine what we do for the next couple of hours. Maybe not the rest of the day, because very often people will offset their positions going into the weekend, especially with geopolitical risk. Okay? But it's important to know that this is an important line in the sand. Okay? So there's your leading indicator. Oh, Bitcoin coming down. Why? S&P 500 coming down. Okay, we're watching that minute for minute. Okay, you're welcome. Nothing compares to you. Well, Burns says, I expect a bounce on Bitcoin soon. While your expectation is fine, But you must confirm or deny that with technical analysis first. Otherwise, your expectation is a gamble. And I think you're better than that. So now go into that expectation, set it up on the chart, and then confirm it with technical analysis and be ready. Okay? By the way, there's my little X. There's my line in the sand. Were my 2 points important? How do you feel about that? Were these 2 points that I made a big stink about, were they important price levels? Right on, Stevie. Thank you for that. By the way, guys, FX Bootcamp is $88 a year to get all this knowledge. Obviously, I'm not trying to get rich. FXBootcamp.com. It's a place to start, man. I think it's 65 hours of training for $88. It's not even $1 an hour. Join FX Bootcamp. Sure, Bernd. Well, you're right. That's why I give you a year. Nothing compares to you. Look at even these ones. Cool. Well, they're just buy and sell zones. Passion. They're just buy and sell zones. And it's just price action that we're looking at. Okay, but one of the things, like, let me revise this line now. We already know it's important. Well, let me just add a third one then. Okay. Do you remember what this line was? That was the market open low at the time. So you were talking about volume, right? So I'm only trading, or let's say I generally only trade around market opens when volatility is high, so it's not an issue. But the thing is, at that time, that was the market open low, and I'm like, I'm going to mark this. Okay? There was a break, pull back, and I showed you sell. I showed you. And some guy's like, are you going to pull the trigger? I'm like, dude, I already drew it for you. What's wrong with you? If you can't make a decision, then you don't deserve the trade. Okay? Then I went through and I showed you the importance of this number, and the whole damn thing stopped. So what's the next point? It came all the way back to my line again. The market open low in that moment. And then it came back down again, which is the same as this trade. To me, it's the same trade. This one, I'd really have to zoom in, but down, down, down. It broke, pulled back, and then it fell. Well, if this was instead of 1 minute, but instead of M1, this was H1, what happened there? Well, in H1, it just did this, which is the same trade. Different people took the same trade using the same technique, but just on higher time frames. And we call that fractal geometry. Oh, I love this stuff. Isn't that fascinating? you're going to be able to talk to people this weekend and say, man, I've been studying fractal geometry when it comes to the foreign exchange market, and I'm finding it fascinating. And your friends will say, oh my God, I didn't think you were that smart. And you're like, I know, right? Right? But it's cool, right? That's right. Right, Kevin. Yeah. Yeah. Well, yeah, we're supposed to be at a 5-year low. What's now what we're supposed to be doing is building inventories up, and that's what it comes from, right? Oh, did I just kill that? No. There we go. I want to reiterate a few things. Okay. I'm bullish on Aussie. I'm actually neutral on US dollar right now. But I'm becoming more and more bearish on Aussie dollar, or US dollar, sorry. So that kind of gets into this. If you read my book from 15 years ago, the book says, in this scenario right here, buy Aussie dollar and walk away. That's what it says. That's, okay, this is a market move. Currently, I'm measuring the speed and direction of the market, and it says, never, ever, ever in a million years could I ever, ever, ever even consider selling this pair based on my analysis of the four-hour chart. I can't even think about it. So the only thing I'm thinking about it, I want to buy this. Now, of course, market conditions will change and my chart will confirm that, and I would have to like reposition myself. But right now, I'm not even allowed to think about it. It's not even an option. So I'm either buying it or I'm not buying it. Okay. Now, going into to now, okay, Aussie dollar's been falling for the last day and a half. But I already knew that was going to happen. Okay. That's what that red spot says. And that red spot was set in stone when we were down here. This is when it was locked. Now, we had a pretty good idea what it would be before that. But nonetheless, this is the moment in time when this price was set in stone. Locked. Okay? So this was on Sunday night. The chart said the top of the market is 73.52. Not an opinion. It's just what it says. So we hit that, and again, in my book, I call it the pivot profit zone. And I spent a lot of time thinking about what to name this because I invented it. And the reason it's called a pivot profit zone is because I want to convey that there are no sellers here. It's not an entry. It's an exit. This is the next technical entry. And who's going to do it? the guys that bought this, took profit. Okay, so in, take profit, in. That's how I think about that. And if things change, for example, these moving averages roll over, or the price action changes, or the lexicon of the market changes, well, then I need to adapt. Okay? But this has been technically bullish since February 8th. It went from bearish to neutral to bullish. Okay? And on Sunday and on Thursday, I explained to my two different groups that it has to do with a 9-month cycle that is just beginning. So you're like, Wayne, I should buy Aussie dollar for 9 months? No, I did not say that. That's not what I said. But the cycle that's creating the current momentum in this pair is a 9-month cycle, but the cycle changes, and the pairs that will benefit or be hindered by this 9-month cycle changes throughout the cycle. But if you don't understand what's happening, then you're not like, you don't get it. You're not on the clue train. And so, I mean, you'll do all right. I mean, the technicals will always confirm, right? So like, things might change, but I'll tell you, that's not a good sell, but you can sell it. It's not a good one, but you can do it. See you, Robin. Robin and stealing, right? Drinking and robbing. Robbing and stealing. How does it actually go? Let me think further back. Skirt chasing, freebasing, killing every villain. Drinking and robbing. Robbing and stealing. Yeah. Make sure you share that with the kids. Okay, so S&P 500 not doing so well, huh? Bad day in the markets. Hey, man, I think it's going to change. Doesn't have to change today. Do you always trade the 1 minute? Hell no. I'm a global macro trend trader. But the thing is, can I trade the 1 minute? Oh, yeah. Yeah. But do I always? No. Okay. Stock market at S&P 500 at 43,000. I have a buy order at 4,000, but I don't think we're going to get there. I don't think that's where we're heading, but whatever, it can do whatever it wants to do, right? Cool. So is anybody going to join FX Bootcamp for $88 a year? Is that too much money? Yeah. But anyways. Well, this is where I need to say my final goodbyes and my bid you adieu. I'd like to thank the moderator for moderating. Pasha, why don't you go to the website? It's on the homepage. Every single topic. Cool. Okay. How do you watch me every day? Open an account at tradersway.com. There's a link in the back office to my daily live stream. A demo account is perfectly fine. Tradersway.com. Johnny says the last low is at 41. I think I bought it at 43. I'm pretty close to break even from last month. Cool. So again, thank you to our moderator for being a wonderful moderator. I'd like to thank FX Street for hosting. I've been working with FX Street for, I think, 15 years. No, of course it's more than that. 17 years? Is the relationship about 17 years now? So I value that relationship and I enjoy being here. I enjoy the camaraderie of hanging out with you guys through Non-Farm Payrolls. And so thank you for the interaction and all that kind of stuff. And thank you for watching my back for me. I appreciate that. I hope you learned something today. Maybe if you did, document that, what you learned in the conversation below. We covered the future value of money calculations. We covered the capital asset pricing model. We covered the solo growth model. Those are just some of the things that we covered today. So very interesting. We covered trapping and breakouts on market opens. We talked about understanding the importance of fundamental analysis and how to use it. That fundamental analysis is not news, but instead a trend in economic data, which you compiled with the hopes of understanding how the central bank is going to interpret the same trends and adjust their policy. And then, of course, you can then say, if they are about to change their policy, you have an understanding of how that policy change would change the value of almost any asset. Because, right, as Raymond brought up in the beginning, every asset is going to be attached to a unit of account, typically a currency. Okay, yes, we covered support and resistance. We covered pivot points. We covered price action. So I hope it was a good investment of 3 hours of your life. So thank you for that investment, and I hope I provided a return for your investment. If you want to, like I said, hang with me, open an account at Traders Way, subscribe to the FX Street YouTube channel. I'm here every month. My chart indicators are at metatraders.com. You can get my video training courses at FX Bootcamp. There's a lot of resources out there to help you. And there's no need to try to figure out how to do this on your own. And, 95% of people think they can figure it out on their own. And then 95% of all retail traders fail. So, more than ever, peace on earth. May the pips be with you. May your profits be above average. Have a wonderful weekend. And maybe if you join my day trading group at fxbootcamp.com, I will see you Sunday afternoon to catch the market open. Cheers.